Hello, this is Brian Decker with Guaranteed Rate. One of the questions I've been getting a lot lately is why is a certain amount of money being collected for taxes and insurance at closing of a purchase loan, and why do those amounts seemingly not make sense? So anytime a client typically puts down less than 20% on a conventional loan or gets any type of government loan, USDA, VA, or FHA, what's called an impound account is required. And think of it best as a little savings account that's attached to your mortgage, that's held by the mortgage servicer, that'll pay your taxes and your homeowner's insurance throughout the year of the course of the process. So when you make your mortgage payment of principal, interest, taxes, and insurance, a certain portion, or 1/12 of the annual homeowner's insurance and 1/12 of the annual tax bill, is collected on a monthly basis and set aside in a separate impound account. Now, when you go to actually purchase a loan, I want to explain to you why the amount of taxes and insurance being collected is so. So for an example, say a client goes ahead and they're going to buy a home and they're going to close that home in the month of March here in California. Property taxes in California, tax bills are due in February and in November of each year. And most mortgage banks pay them in March and December. And if you pay it after December 10th or after April 10th, it's tax penalties. So most banks actually remit those payments very early in December or very early in March. Okay, so for an example, if somebody's to close on a home loan in the month of March, what they're going to see collected on their closing statement is 5 months worth of property taxes from the buyer. So they're going to typically have about 3 months collected for the tax bill that is due right then and there, as well as about 2 months placed into that impound account. And then the seller of that property is going to be contributing roughly about 3 months of taxes. So the tax bill at the close of escrow takes place in March is going to be paid through closing of a 6 months property tax bill. That covers from January 1st to June 30th on that March tax bill. So you're going to see 5 months being collected from the buyer at closing, plus the seller is going to be contributing 3 months, starting off with an 8-month balance, we'll call it, in that escrow account. Now immediately through closing, they're going to be paying 6 months worth of taxes, leaving you a 3-month balance. Then when the April payment's made, it goes to 4 months, May 5 months, June 6 months, July 7th month, so forth and so on. Every month when you make your tax payment or your mortgage payment, one property tax installment is going to be collected equal to 1/12 of that. Then when that tax bill is due again, you're going to receive a reduction of 6 months in taxes being taken out, leaving you 5 months in that escrow account, or 5 months worth of taxes in that escrow account. Then once the December payment is made, January payment is made, February payment is made, we now have 8 months worth of taxes in that account again, and 6 months is then paid in March again, beginning of March, likely before a lot of clients make that March payment, leaving you a 2-month balance. Now the reason why we always have a 2-month buffer, almost all banks in the country collect a 2-month buffer in that account, is for a couple reasons. One, if the property taxes at all are reassessed during that time, we have a little bit of a buffer to cover that shortage for supplemental taxes. And two, if a client gets behind on their mortgage, that way the bank already has the buffer to pay those property taxes when due. The same is true now for your insurance. So at close, you're going to pay the insurance in closing. Now, a homeowner's insurance policy is an annual policy, so it's going to be paid at closing in full for 12 months. Then they'll be collecting 2 months of reserves to put in that same escrows account, which also takes place of your property taxes. Then every month when you make your payment, 1/12 of that homeowner's insurance is put in that escrow account. And then in a year from now, you'll have 12 months worth of insurance in that account plus the 2-month buffer. And then they remit that payment again a year from now. That 2-month buffer works the same way, just in case the insurance increase. Insurance is always increasing year after year, typically for most homeowners insurance policies. That way too, if there is a little increase, there's enough in that account to pay that for those escrows. So I hope that gives you a little bit better idea on the way escrow accounts work. I hope you guys all have a great day, and thank you again.